Hi, good afternoon. I'm Patrick Socci. I'm Dean of the Zarb School of Business here at Hofstra University. Welcome to Hofstra University and the plenary session on economic policy in the Bush administration. Working with me today at this session is our Provost, Dr. Herman Berliner, who will be asking some questions. And we're happy to have three presenters, although one is still at the airport and hopefully will get here in time. But if not, we will still have two magnificent speakers here who can give us some real insights on how economic policy was developed within the Bush administration. And you could probably then extrapolate how it may happen in other administrations. Our first speaker today is Pia Orrenius. Currently, she's Vice President and Senior Economist at the Federal Reserve Bank in Dallas. Ms. Orrenius is a labor economist working on regional economic growth and demographic change. She manages the regional group in the Dallas Federal Research Department and is executive editor of the quarterly publication Southwest Economy. Her academic research focuses on the labor market impacts of immigration, unauthorized immigration, and U.S. immigration policy. She is a co-author of the book Beside the Golden Door, U.S. Immigration Reform in a New Era of Globalization. Ms. Orrenius is affiliated with several academic institutions. She is a research fellow at the Tower Center for Political Science at Southern Methodist University and at the IZA Institute of Labor in Bonn, Germany, as well as a visiting scholar at the American Enterprise Institute. Ms. Orrenius is also an adjunct professor at Baylor University, where she teaches in the Executive MBA program. Ms. Orrenius was senior economist on the Council of Economic Advisors in the Executive Office of the President in Washington, D.C. in 2004 and 2005, where she advised the Bush administration on labor, health, and immigration issues. She holds a PhD in economics from the University of California at Los Angeles and a bachelor's degree in economics and Spanish from the University of Illinois at Urbana-Champaign. Our second speaker is Phillip Swagel. Phillip Swagel is an advisor to Evenflow Macro and contributes to the firm's economic and political policy analysis. Mr. Swagel is a professor at the International Economic Policy at the University of Maryland's School of Public Policy. He was Assistant Secretary for Economic Policy at the Treasury Department from December 2006 until January 2009, serving as chief economist for Secretary Henry Paulson. He was previously chief of staff at the White House Council of Economic Advisors from 2002 to 2005, and an economist at the IMF, that's the International Monetary Fund, and the Board of Governors at the Federal Reserve. At Treasury, Mr. Swagel was involved with a range of policies including TARP, housing, energy, environment, pensions, and macro analysis. He's been especially involved lately in the policy efforts concerning housing, finance reform, and broader financial regulatory reform. Mr. Swagel received a PhD in economics from Harvard University and a Bachelor of Arts in economics from Princeton University. Our third speaker, hopefully he'll get here in time, is Marc Sumerlin. Evenflow was founded by Marc Sumerlin. Previously, Mr. Sumerlin spent 10 years as managing director of the Lindsay Group, a global economic consulting firm. During that time, he traveled extensively to Japan, China, Arabia, Germany, Great Britain, France, Italy, and Switzerland. From 2001 to 2002, Mr. Sumerlin served as Deputy Assistant to the President for Economic Policy and Deputy Director of the National Economic Council. In that capacity, he helped the President of the United States develop and implement his economic agenda. He also worked as an economic policy advisor for George W. Bush for President after he started his career at the U.S. Senate Budget Committee. Mr. Sumerlin holds a Master of Arts in Applied Economics from Johns Hopkins University and a Master of Public Policy from Duke University, where he was a Senator Jacob Javits Fellow. He graduated magna cum laude from Georgetown University. Mr. Sumerlin currently serves as a board member of Dow Arabia, a Hunt Consolidated affiliate based in Kuwait City, and is on the board of the Virginia Hospital Center Medical Brigade. So thank you, and I will now, Mr. Swagel will start with his remarks. He also has Mr. Sumerlin's remarks if he doesn't get here in time, and then Dr. Orrenius will present her remarks, and then we'll have questioning. Thank you.
Great, thanks very much. So I'll start with mine, and Mark should be here in the next couple minutes, and if not, I have his, and I can talk about his role as well. So I was, at the end of the administration, I was the Assistant Secretary for Economic Policy at the Treasury Department. So essentially, Chief Economist for Secretary Hank Paulson. I was confirmed by a voice vote of the Senate just before the Senate flipped in December of 2006. So just when it changed from then Leader Frist to Leader Reed, and obviously it's since flipped back. Back then, non-controversial nominees got approved routinely. So that's obviously it's different. I had previously served at the Council of Economic Advisors, where Pia and I were colleagues, and also that was when Marc was a deputy at the NEC. Now, I was actually at CEA twice. First in a non-political position the last 6 months of the Clinton administration and the first 6 months of the Bush administration, working on trade policy. I was doing that on leave from the International Monetary Fund, went back to the fund, and then came back a year later in a political position at the CEA as Chief of Staff. So Marc's going to tell you later about a little bit about the campaign, but I will just preemptively confirm something that I know he's going to say about the seriousness of the campaign policy planning and the way that affected economic policymaking in the Bush administration. So again, I was there at the first day of the administration as a non-political appointee, and so it was very typical in meetings early in the Bush administration to hear discussions about how proposals, whatever was being considered, how did that line up with what was discussed during the campaign. So the campaign promises of then Governor Bush, President-elect Bush, were taken seriously, which was fascinating. And I suspect it's quite different than some other administrations. At Treasury, I worked on a range of issues. The financial crisis obviously dominated much of my time at Treasury, but I worked on Social Security, on immigration, on healthcare, a bit on energy and the environment. And I think all of these areas are ones in which the Bush administration had serious policy proposals that would address the serious challenges facing our nation and deserve consideration on their merits. My sense is that especially after 2006, that is, starting with the new Congress in 2007, they didn't exactly receive that serious consideration. But that's just a fact, and it's a fact of our polarized political system. So that's the way Congress worked then, and it's the way that Congress worked over the last couple years. So let me talk a little bit about the financial crisis in the last couple of minutes here that I want to talk, which obviously is the center of what I worked on while at the Treasury Department. And I'll try to use that to illustrate more broadly the way that economic policymaking worked in the Bush administration, at least as I saw it. And so at the Treasury and throughout the administration, at the White House, at Housing and Urban Development, and other parts of the executive branch, we were well aware of the building imbalances and of the problems in the housing sector and the economy more broadly. Now, I've actually written it on this topic at length. If you Google Swagel financial crisis, you will see that. Maybe it's my fault, but anyway, you'll see what I've written. So policy making across the administration responded. At the White House and HUD especially, efforts were made to come up with policies to lean against the contraction of credit availability in a responsible way, right? So there were discussions on what is the role of the government and what are the barriers to the spread of credit, right? Why is it that credit-worthy people were getting mortgages before, maybe too easily, but now they can't, and what was the role of the government in addressing that? And there were proposals from the FHA, the Federal Housing Administration, and HUD, and other parts of the government to address this, right? So in some sense, not assuming that markets are perfect, and not assuming, let me say it positively, and saying there is a role for the government, but I would say with a high bar for action to avoid the possibility of unintended consequences. And obviously, compared to other administrations, there was less government involvement, but not by far not the caricature of none of laissez-faire. Okay, so the crisis manifested in August of 2007. There were policy responses from the Fed. From the administration, again, the focus was how to help the market adjust, right? So at the Treasury, there are proposals on what to do about illiquid assets and proposals about how to avoid preventable foreclosures, right? So it wasn't that the government, the Bush administration did not propose taking taxpayer money and saving people from foreclosures, but the focus was on saying, look, a foreclosure is costly, right? It costs the bank money, it costs obviously the family involved. It's terrible for them and very costly personally and financially. And so there should be a way for the two parties to work things out. And that wasn't working very well. And so the administration and the Treasury Secretary personally were very engaged in getting that process to work better. Now, what's interesting in my mind is that these efforts were then later used as the basis for housing-related efforts from the Obama administration. Now, they of course put taxpayer money into it. To lots of criticism, right? I mean, so it's just why am I paying taxes so Pia, can buy her third house and have a couple big screen TVs? I think those policies were actually more effective than people think for the Obama administration, but they sure took a lot of criticism. There's a book about the crisis that makes this connection, that calls the Obama approach to housing the Swagel plan, which it's meant as a pejorative. But obviously, I was gone on January 20th of 2009, and so their plan had nothing to do with me. Okay, so very briefly, the way I think of the crisis is in three phases, right? From August 2007 to March or April of 2008 was kind of the normal policy response, right? I told you what the Treasury and the administration did. The Fed was doing its normal monetary policy response of lowering interest rates. And then, of course, Bear Stearns collapsed, right? So the collapse of Bear Stearns and its acquisition by J.P. Morgan signaled that this was no longer a normal slowdown, and that the mode of work within the administration changed, right? So the work was being driven out of the Treasury Department, so it's appropriate that I speak about it, but it was very well coordinated within the administration, right? So again, the way the policy process worked is that generally the National Economic Council, where Marc was the deputy at the beginning of the administration, would coordinate a policy process and bring in the other parts of the administration that were naturally involved in this. So that the financial crisis response was typical and unusual. Right? It is typical in that the NEC process worked, and there continued to be the sort of NEC process that Marc was here. We'll talk about at the beginning. But by the end of the administration, the process, in some sense, the work was being heavily driven out of the Treasury Department, which again was natural given the nature of the work. So the second phase was coming up with plans, and again, if you do the Google search that I told you, you'll come up with some memos that were written about potential government plans to address the crisis. Okay, that's the second phase. The third phase then, of course, was from September on with the failure of Fannie and Freddie and Lehman Brothers, AIG, and more. And the way I think of it is that actually my boss, Hank Paulson, he had a saying that I think is instructive, right? So people would say, oh, it must be really tough to do this, or to bail out this company, or to take this action to invest $350 billion of taxpayer money in banks. It's $250 billion of taxpayer money in banks. And his response was, it's not a hard decision, it's just an unpleasant one. Right? So it wasn't, so he said, look, it's the right thing to do. I know it has to be done. I don't like doing it, but it has to be done. And I think that was the approach. I suspect that sort of approach would apply for President Bush as well. Right? Right, he had a set of core beliefs that I think Marc will talk more about. But addressing a crisis, he's a very pragmatic man, and is a very pragmatic administration. So I would look at the work that was done during the financial crisis as following that script exactly. And then to to me, what's fascinating is that in some sense the new administration, starting in January 2009, really continued the work, right? The TARP continued with essentially superficial changes. The people working on the TARP continued, including the head of the TARP, right? Tim Geithner, as the Treasury Secretary, was one of the architects of the whole thing, of the crisis response. So there's a great deal of continuity in the financial crisis response between the two administrations. And obviously, the president or none of us were happy about getting to this point, but I think the administration's record can be, in some sense, comfortable or clear that the response was appropriate and ultimately effective. So one last thought, which was obviously the economic policy at the end of the administration was dominated by housing and by the financial crisis response, which of course meant there are things left undone, right? President Bush started on a climate change agenda, gathering the G20 nations for the first time on this. There's work on financial regulatory reform, housing finance reform, Social Security reform, tax reform, a whole host of other issues that in some sense got crowded out by the financial crisis. But that's in some sense the way it had to be. So why don't I stop there?
No, you're next.
Okay, perfect. All right, well, thank you guys very much for having me, and sorry to come in late. You can tell how long I've been away from working for President Bush, because being 15 minutes late would have been grounds for termination back when I worked for him. So I started off working for then Governor Bush in June of 1999 during the campaign, and I worked until a year after 9/11. When the time that I was in the White House, the Bush administration, President Bush averaged 71% approval rating in the polls. And so my perspective is very different, and it's often there's a cycle to the presidency, and working at the beginning of the administration is often very different from working at the end. Phil would probably tell you those were the good old years, but when you're running for your life on 9/11, they don't actually feel like the good old years. And if you look at the heads of hair of any president we have, every single day in the White House is hard, and you can see the constant grain that goes on, whether it's good times or bad times. So I want to start off a little bit with the campaign. I feel very strongly that the policy making in the Bush campaign was actually much more serious than in most campaigns. President Bush had a absolute rule that everything that we proposed had to have the chance of becoming law. So there was nothing fantastical. There was no flat taxes or gold standards or dynamic scoring or universal health care. They were all very pragmatic. That's not to say universally popular, but they were all things that with a little bit of effort could actually become law. We, over the course of the campaign, produced 2 full policy books. These are things that you have not seen in more recent campaigns. And we kept an actual CBO scored budget, and all of our proposals on taxes we had scored by the official scores in Congress, JCT. So at the point of the election in 2000, everyone knew how much the Bush tax plan would cost. They knew what the distributionals were, whether it was how much was going to the rich, how much was going to the poor. You knew about problems like the AMT, and none of that is to say you would like the tax plan or not, but it was a very honest way of saying it, and things were out there. So when we started, Governor Bush, as when he was in Texas, had run on 4 things, and he had kind of had 4 accomplishments. And one of the biggest ones was cutting taxes. And so that was something that he believed in and was going to be a core part of the campaign. And so what he did is he assembled a team of 10 very prominent outside economists. These included 2 past CEA chairmen, former Federal Reserve governors, 2 former top OMB officials, and charged them with developing a tax plan that was both something that could eventually become law, but also something that would be bold enough to survive a Steve Forbes-like challenge from the right during the campaign season. Now, it seems a little bit crazy here in 2015 to imagine people in 1999 being scared of Steve Forbes, but he had come off the 1996 campaign as being one of the thought leaders on the right. So we started a process that went for about 6 months. And within those 10 groups of economists, there were very different reasons that they wanted to be embedded within the tax plan. And the more philosophical conservatives started with the fundamental premise that the government was in surplus, that the surplus is inherently belongs to the people who earn the money, and therefore part of it should be returned to them. And that was the philosophical point. We also had, and people don't often realize this, we had a number of neo-Keynesians in the group. And for them, the focus was that the expansion was starting to get pretty long in the tooth, and that we were year 8 or 9 in an expansion, and the idea that we were going to make it another 4 years without a recession seemed not to be consistent with history. And this was something that then Governor Bush was actually very sympathetic to, having started off in the oil patch in the 80s. Any Texan is very sensitive to the fact that there's a very pronounced business cycle. Then we also had a group that were very big supporters of reforming Social Security, and they wanted to use most of the money for causes like that, and therefore wanted a smaller tax plan. And so that was the tension that operated. In the end, President Bush decided on a plan that would phase in marginal rate reductions over 5 years. Internally, we had discussions about if the economy weakened, that would be available to speed up to provide more demand-side support. And so then we get past the election, we come into office, and there's always a little bit of tension at the beginning of administrations, and there's a particular one with the Treasury Secretary and some of the new members of the econ team who wanted to start clean and say, okay, the campaign is over, and now we have a new set, bigger group of people in, and let's start from scratch. Governor Bush had a very different mindset, which is that elections matter, and that he was planning to govern on what he campaigned on and continue the theme of only develop things in a campaign that could become law. So we stuck with the tax plan. I was part of the 3-person negotiating team on the Hill, negotiated over 5 months, and it became law in May of 2001. And one of the lessons I learned during those negotiations is that, and this applies to all presidents, past and present, is members of Congress are not going to take political risk that the president himself is not going to take. And so I could talk about any economic argument or tax policy argument, but at the end of the day, what the member wanted to hear was everything about the tax plan was out in public at the point of election, and the president had survived, and he had actually taken political risk on that point. And after that point, it was not that hard to get the votes. When the bill went before the Senate, it got 63 votes. People in history remember it being very partisan, but that was a Democrat-controlled Senate, including the chair of the Finance Committee, supported the plan. And I think another lesson from history is that things have to have some amount of bipartisanship, or they will be relitigated time and time again. And that's been a problem with the Affordable Care Act. When there wasn't a single Republican person who votes for it, then it's just going to keep coming up and up and up and up. We then go on. The economy, as we approach the 2000 election, was clearly weakening. The first quarter of 2001, the economy contracted 1%, contracted another 1% in the third quarter of 2001, after the events of September 11th. It was apparent in November, we put the vice president on Meet the Press and had him say that we were on the front edge of a recession. You can actually see these things before economists will declare them. The data starts to move pretty decisively. And we then started to work on accelerating the tax cut. The only part that we could politically get accelerated was the low-income part. And so in August of 2001, checks went out across the nation for $600 per person. It's very hard to tell if those worked at all, because they literally went out about 3 weeks before 9/11, and the data got so bad for a couple of months that it either helped a little bit or didn't help at all. It's very hard. It's hard to decipher that. The economy then continued to be what we would call sluggish through 2002 and into 2003, in part held back by the debate about going to war. And so the president made a decision to accelerate the marginal rate cuts, and was able to get that through Congress. And in May of 2003, the full tax plan hit for the first time. The third quarter of 2003, the economy accelerated by 6.9% in real terms. And over the 2 years after the tax plan took effect, it accelerated by 3.8%. These were the best couple of years of the presidency, and I think fit with the historical lesson from President Kennedy and from President Reagan, that tax cuts that are permanent in nature have more powerful economic effects than those that are temporary. They obviously have a much bigger cost, but you have to decide whether it's worth it or not for their effect on the economy. I will go ahead and stop there and turn it over to Pia, but I just want to give you a little bit of flavor of what the tax policy was like during the administration, and we can talk more about how the National Economic Council works during questions or other things like that.
Thanks, Mark. So I was not a political appointee in the administration. I was a staff economist on the Council of Economic Advisors, and Phil hired me. Thank you, Phil. It was a great year. I would say it was the most exciting year, certainly in my career so far. I had 3 chairmen when I was in my 1 year at CA, which might be a record. Came in under Greg Mankiw, amazing guy, a macroeconomist, obviously professor at Harvard, and then after that it was Harvey Rosen for a period of time, and then at the end Ben Bernanke. So I just really had amazing chairmen, amazing economic thinkers, and I really had such a rewarding year, surrounded by some of the brightest economists that I've ever met, really. So the reason I think Phil hired me was because in January of 2004, as Mark described, we were coming out of a recession in 2001 and then a jobless recovery for 2 years, or a little over 2 years. And so immigration, which is my field, had been taken off the table. I don't know if you remember, when Bush won the election, and very soon in his first term, he began talks with Presidente Vicente Fox of Mexico on an immigration reform, an immigration plan with Mexico. And so that was sort of, we got the sense, although Mark, you probably know if this is true, but that an immigration agreement with Mexico was imminent, and that was the week before 9/11. And then, of course, after 9/11, immigration again wasn't mentioned for 2.5 years for obvious reasons. But so in some sense, those of us who work on immigration, who yearn for immigration reform, we're sad about 9/11 for many reasons, but of course that's another reason, because that reform was squashed and an important opportunity was lost. But anyway, so I came to CA with high hopes that maybe this would be the year for immigration reform. And of course, once the president's new term began, we started immigration talks in earnest within the White House, and I thought we made a lot of progress. We worked mostly on what a temporary worker program would look like, which was going to be sort of the hardest part of the immigration reform, and something that obviously Congress had not really hammered out yet. And so we worked a lot on that. And it was nice to work in a field on a topic where President Bush really had very strong guiding principles for us. He felt very strongly. He also understood it very well, being from a border state, having huge Hispanic support in the election, I think, for a Republican. He had done very well, and so he's very close to this electorate, very close to the issue, and provided us great guidance. So I felt very strong working on it. I felt like we knew what we needed to come up with. Of course, immigration reform never did work out. I mean, the McCain-Kennedy bill eventually did pass the Senate, but didn't pass the House, of course. Never was taken up, I believe. And the House in 2007 would respond with the Border Security and Fence Act, and lots of enforcement, more border enforcement, more interior enforcement, and from there on in, the situation for immigration reform certainly deteriorated. From my point of view, anyway. And if you see President Bush today, I think he'll openly say, his big regret was after being elected, in the beginning of his second term, focusing on privatization of Social Security instead of immigration reform, and he'll tell you that. And I think he really means it, because it's an issue very close to his heart. I think this concludes my prepared remarks. I'm happy to take questions.
So we will ask a number of questions, and we welcome the audience asking questions. So I guess the question to start with to all three is, what would be the long-lasting effects of the Bush administration economic policy? What has stood the test of time best?
Okay, Sure. I can think of two things. So first is tax policy, and I delight in saying this. The Bush-Obama tax cuts are now permanent, right? So it's I delight in saying that just because there's so many people who, for a certain period, would sort of wake up in the morning before brushing their teeth, would think about how terrible the Bush tax cuts were, and of course President Obama, for a year or two, right, extended all of them, right, including the top rates, the state tax, everything, in some sense acknowledging, the positive impacts on the economy or the negative ones from reversing them, and then made permanent, the vast majority of them, including the overall guiding structure. So I think that's a permanent change, or as far as our republic goes, it's a relatively permanent change. The importance of tax policy. Number two, though, so that's the good. I say with a bit of a little bit of a smile. The bad, of course, is polarization, and it's look, we can't replay the decade, the current time, but I think of proposals on Social Security, on healthcare, and other things that in some ways never got consideration, and the sort of the debate was symbolic and political and not substantive, and that's this falls for everywhere all around, but I think that continues, and so and that's also I think a long-lasting impact of the administration.
Great. I think from my time when I was there, I think that history doesn't give him enough credit for how shallow and brief the 2001 recession is. That was a time that we had a massive collapse of a stock market bubble, that there were trillions of wealth loss, that confidence was very low for a month or so after 9/11, and that was the period where the economy could have really seized up, and it didn't for a number of reasons. And if you go back and look at the data, it was extremely small, and so I think the economic performance over the first term was actually pretty good, given that we came in with massive stock market overvaluation and huge corporate indebtedness that had to be adjusted. I think that, oddly, on economic policy, I'm a little more optimistic on immigration, and so I think we may look back 15 years from now and find that President Bush was on the right side of immigration, and that we're in a temporary working out period for the party, and that hopefully it will go back to a more welcoming stance. One of the things that I tell politicians, to make it very simple when they're thinking about immigration policy, is there's really one measure of a country economically over time, and that is, are people trying to get into it, or are they trying to get out of it? And so if you tell me the biggest problem the United States faces is that people are trying to get into it from all around the world, I'm going to go worry about something else. And I think that this debate, hopefully, it will depend a lot on who the candidate the Republicans pick next year is, but people might look more kindly back on President Bush for having been on the right side of that debate.
I think a key piece of the Bush legacy will be bringing education policy into the federal government. I think that, No Child Left Behind, although I'm not sure in what state it finds itself at the moment, but it's one of those policies that maybe hasn't carried over into the Obama administration. But I think this idea that President Bush had, even in Texas, he was an education reformer, and he took this with him to Washington, and he had very high, I think it says a lot about him. First, in terms of his political philosophy, and we talked about this earlier in a session earlier today, I think it suggests he was not a laissez-faire president. In fact, you think he's a president who believed that government could be very purposeful, and that it had a purpose in education and a role in education. And I think the conversations I got to sit in on when I was at CA on education policy, I found fascinating, because just the high standards that they were setting, which I thought were unrealistic, but it was great. It was great. The foundations upon which No Child Left Behind, although it's very controversial, I still think that those foundations of transparency and accountability are really important, and I think we'll never go back.
You've touched on this. You've indicated that President Bush had strong guiding principles on immigration. Where else did he have strong guiding principles when it came to the economics of the country?
He definitely had believed as a principle that taxpayer money first and
let's see if there's some questions from the audience. If not, Dean Socci and I have a whole list of questions, so we are ready. Professor Parati?
I want to ask Dr. Orrenius, is the moment for immigration reform gone? Was there just that brief moment of hope in the beginning of the Bush administration, and is it in our future?
Well, that's a tough one. Is the moment gone? No, I mean, it's a huge looming problem out there, right? It has to be addressed. I wonder, though, if it'll now get addressed in the next administration, because obviously at the current, I mean, if it could have gotten any, I mean, we thought it was bad a year ago, but it got a lot worse in November with the executive action of the Obama administration, in the sense that something that was extremely controversial already became even more controversial, and now a whole other set of issues have been piled on to what's already a really, again, a controversial topic. And so now it's about presidential overstep and so forth, and what are the limits of executive action and everything. So that's now thrown into the debate on top of everything else. But I think that, I think that the way to do it is out there, and I think we know how to do immigration reform, and I think we have, we've come a long way in that. After I left, when I was in the White House, nobody would ever have suggested that that undocumented immigrants might get a temporary status and not a pathway to citizenship. Everyone was sort of still thinking along the lines of the 1986 Immigration Reform and Control Act, or the 1986 amnesty, some people call it, and we all thought these people should be made permanent and should have access to citizenship and so forth. And I think it was after I left that, I think it was Karl Rove actually who brought up the blue card, and that was for the first time somebody raised the possibility that to sort of be able to bridge the divide in thinking on immigration reform, we might offer these people temporary status. And so I think, although that was unfortunate that you can't get, your everything that you want, perhaps, but still that's a step to, bridging the divide and moving the debate forward and finding solutions that are going to work for everyone. So in that sense, I think we know how to do it. I think I would argue that we know how to do immigration reform, and I think we know how to do it right now, and it's just getting the politics to work.
I have two thoughts on that go well with what Pia said about the politics, and that's about one from 2007 and then one from 2014. So 2007, I was at the Treasury, and I participated a little bit in some immigration discussions. And the discussion then, at least just the part I participated in, so it doesn't mean it's the entire discussion, was really about members of Congress to the right of John McCain. And sometimes, what can we do just to make them feel better about supporting the proposal? And so there are a number of things that are aimed at border security and people here illegally and things like that sometimes politically seems skewed in one direction, and of course one could look at that and say, well, look, President Bush at the time, this is before the surge was clearly working and really needed the support against critics in Iraq, right? Senator Reid saying it's a lost war and things like that. So again, it's before President Bush's surge policy worked in Iraq. So it was 2007. 2014, what was fascinating to me, of course, is President Obama paused his executive action to allow the endangered Democratic senators to have a chance, and it didn't work out well. But he paused it there, and then didn't wait long enough for the new Congress to have a chance. And I understand it politically why the pressure was on him, and from the White House perspective, he might have said, oh, look, Speaker Boehner can't control his caucus, there's no point in waiting. But it's fascinating to me, he didn't give the Speaker a chance to fail. And I think that's really too bad. But I agree with Pia that it's going to happen. It's just, we're in a little bit of a politically induced timeout, and I think I've named the person who I think is responsible for that timeout, and we'll just have to wait until it ends.
Professor Bose.
been the subject of much debate as far as what the long-term effects are. Certainly, the short-term effects were very strong for the majority of American families. The two issues that I was wondering if, I guess, Professor Swagel, you raised the tax cut, so maybe start with you, and then if others would like to comment. The wealth gap, or the question of growing inequality in the United States, and the question of whether the tax cuts then meant less money for the government when it came to waging war in Iraq. And so the tax cuts meant more money for American families, less money for some of the foreign policy needs, and also more recently infrastructure questions. So I guess if you could speak to those questions, that would be great.
Yeah, no, I'll go ahead and start. I mean, so one, you always start with the numbers. I mean, so the Bush 2001 tax cut cost $1.3 trillion over 10 years. So it's a lot of money. It's also about the same as the Obama stimulus plan cost in 1 year. And so it's not, sometimes the rhetoric doesn't always match reality. Also, the biggest, by far, differences in what happened to the surplus were more based on changing economic performance, and if you throw in a recession or two, that just blows out your budget numbers much more than anything else. You see huge declines in bonus income and capital gains, and so I don't think the tax plan in any way restrained the spending on the cost of the war. That seemed to go on its own, on its own trajectory. But yes, there is a choice between, government finance infrastructure spending and tax cuts, just like there's a choice between tax cuts and any type of government spending. So that is a budget decision. I would just point out that we have, actual data on what happened after the tax cuts happened that make it a decent argument for why they should have occurred. I forgot what the second.
Infrastructure.
Infrastructure. Oh, one thing on the wealth gap, because I think it's really important, is the growing wealth inequality, and what point tax cuts play in that. Mathematically, by far, the biggest contributor to the wealth gap is Federal Reserve policy, which is designed intentionally to drive up asset prices. And so if you want to objectively measure wealth inequality over the last 5 years, it is done mainly by the Federal Reserve. There is a very different standard for judging monetary policy for some reason than for tax policy, when the exact same trickle-down economic arguments you might want to make could be applied to monetary policy just as well. So I would, a lot of times, all policy that gets the economy going tends to have bad distributional effects.
Okay, maybe should I can just add. I actually, it made me think of a funny story that I guess Mark had left the White House by then. So in the fall of 2003, I can't remember exactly. Actually, I could remember exactly the day by looking at the calendar from the Bureau of Economic Analysis. There is an anomalous situation that the head of the CEA did not. There are two dining rooms at the White House mess. There's a bigger one and a smaller one, and the smaller one is for higher-ranking staff. And for reasons I don't understand, the head of the CEA didn't have the smaller one, have access to the smaller one. It didn't make any sense. All the other people like him did. And so at some point I had, just as chief of staff, I just asked. I didn't even tell my boss. I just asked the head of administration, hey, can we fix this? And it was just tough getting a decision. I don't know why. It's like one of those things, right? It's not that big a deal. It's tough getting a decision. And the day in the fall of 2003 that we had a massive positive GDP number, it was like, at the time it was like plus 7 point something. It's since been revised up to plus 8 point something. So showing the 2003 tax cut was working and the economy was back, the request was approved that day. So there's the econ team was down, we're up. It just is the way it happens.
Incentives matter even for.
Yeah, exactly. Incentives matter. So that's about policy making. I would say on the second half of the question about the long run effect, I think it's a really good question. And in my mind, right, the administration in 2005 made a good effort at Social Security reform. Right, it started just as I was leaving, and so there's a focus on private accounts and safeguarding people's people's assets. And you can have a conversation about whether that makes sense and why. But in some sense, you can imagine doing it differently and focusing on this is about fiscal responsibility and the long run future and our children and things like that. And I think that's a debate that we haven't yet had, right? In some ways, we're going in the opposite direction with people saying, let's well, I should say actually, there's wide agreement on increasing Social Security benefits for people who most depend on Social Security for their retirement. So Paul Ryan's Social Security plan has a feature, and Senator Elizabeth Warren has proposed that as well. There's less agreement on entitlement benefits for the people with high lifetime incomes, right? So someone with a high lifetime income is probably not depending on Social Security for the foundation of their retirement, right? And so you can imagine saying to that person, okay, pay more in taxes, or we're going to give you less in benefits. And of course, right, as any business school student would tell you, those are the same over the lifetime, right, abstracting from mortality. And so what's fascinating to me is this sort of very polarized debate about things that mathematically are quite similar, right, cutting benefits for the rich or raising taxes for the rich. And that kind of debate we haven't really engaged in for our society, and hopefully the next president will do that.
Yes, please.
Thanks. We heard a little bit about trade policy yesterday, so I'd like each of your thoughts on trade policy under President Bush. You could argue with a number of agreements that he signed that he was the most pro-trade or pro-free trade president we've ever had. And what are the implications going forward in terms of trade policy, if you see any?
I would start with that was one of his core principles as well. It comes with being a border state that he definitely believed in, in trade policy kind of fundamentally in his bones. From my time that I was there, the big piece on the agenda was getting Trade Promotion Authority, which had lapsed, and that's a power that is needed for the president to actually go in to conduct trade deals. And even in 2002, trying to get that bill through a Republican House, we had to hold the vote open for 4 extra hours and twist arms to get it to pass by one single vote. And so trade stuff is always very hard to get through the Congress. And that was before kind of the rise of China and other things that have maybe put more downward pressure on wages and other things here. And so he was certainly that's something he felt in his bones. Politics are always difficult on trade.
Yeah, no, I agree. I worked a bit on the steel, on the beginnings of the steel protection, and I think it was pretty clear that even that action, which was goes in the other direction, was meant to enable a wider trade agenda. That is, it was a campaign promise first of all, and then to say, look, I will be tough when tough is needed, and you can debate about whether it's needed or right and all that, but tough in this case, and therefore you can trust me on the broader trade agenda. I suspect, right, President Obama feels the same way, that trade is intrinsically good for the American people, for the economy, and for individual Americans. Not every American, but for the United States as a whole. His chief economist has a really great paper describing the positive impacts of low prices, low retail prices. He looks at the welfare gains of Walmart and shows that the low prices at Walmart provide a huge benefit to individual American families, low-income families especially. So it's just, as Marc said, the politics are really tough on it.
Yes, please.
I was wondering to what degree deficit reduction was an internal concern for the administration, and if there was ever a moment where it became a greater concern and people in the administration started to wonder if this kind of national debt inconvenience was becoming more of a potential crisis of its own.
So my time, we started with, during the campaign, there was, projections of large surpluses, so that was not like a huge issue, and it was much more of a focus on the long-term demographic problems, and you could see even back then that 15 years out, Social Security, Medicare, Medicaid spending was going to be problematic, and trying to think more about the long term. And then as soon as you go into recession, though, your policy is going to be focused on expanding it in the short term, the deficit. And so that's not going to be an area of emphasis. And so I kind of went from one extreme in my tenure to the other extreme. And then it was, I know after I left, and the economy stabilized, it was a priority to get the deficit back down to, what a sustainable level is. And the sustainable level has to be, something below 3% of GDP deficit, not necessarily, exactly zero. But a lot of it is just dependent on figuring out whether, where growth is going to be and, where the next recession, and that will really knock you off target more than you ever realize.
I was going to say, I remember in early 2008, after the fiscal stimulus of 2008 was passed, that was only $100 billion, which at the time it seemed like a huge amount of money. And the staff at the Treasury, not political staff, the career staff were really excellent at selling the debt and funding the government. Were worried about could they fund $100 billion relatively quickly. And obviously they were able to, and the Treasury has continued to be staffed by experts and done this a wonderful job of funding the government. And in a sense, we haven't had the market pressure that would make us. And I think that the long-run problems are still there with entitlements. Just as one last thought, as an illustration, I think of Part D, Medicare Part D, which added the drug benefit. And of course, having pharmaceuticals as part of Medicare made sense, right? The practice of medicine had changed substantially since the 60s. But the debate at the time was, instead of not really to have Part D or not to have Part D, the opponents to President Bush thought that Part D wasn't generous enough, right? There's a donut hole. And you ask yourself, why does someone well-to-do get any benefit until they run through a couple $1,000s worth of prescriptions, right? Why do you even have the first dollar coverage for someone who's quite well-to-do? But that was really the debate: was it's not generous enough, it's not costly enough, and in fact, the Affordable Care Act made the drug benefit more costly, right? It essentially made it so rich people got first dollar cover. I'm sorry, that was already done. Anyway, it made other changes to make it more generous and more costly. So in some ways, went in the opposite direction in terms of that, long-run challenge.
Was the Fed helpful or not helpful in terms of the Bush economic policy?
I would say not helpful, because I'm a belief that starting in around 1995, 1997, monetary policy was too easy, and we allowed we being the country, massive corporate credit boom in the late 90s and a massive rise in stock prices that then popped, and then that was repeated in the 2004, 5, 6 period when monetary policy was again too easy and allowed home prices to rise dramatically. And so I think that inappropriate monetary policy was a fundamental source of sort of the instability that we've had in asset prices, and is probably one of the biggest sources of debate within the monetary policy community sort of post-financial crisis about whether or not monetary policy should be broader than looking at just a core level of inflation in goods and services.
So fast forward.
I want to know what Pia from the Fed thinks. No, I'm just kidding.
You probably can't come.
Sorry. No, she can't talk about it.
Okay. Let's fast forward.
Yes.
Is the Fed policy, if you'd like to, it's not the Bush administration, Obama administration, is the Fed policy today helpful or not helpful in terms of looking ahead to the future?
I think the Fed policy should be, right now, be exiting its accommodative policy, that asset prices are again high, that the economy is approaching full employment, and that proper monetary policy would coast the economy into full employment rather than try to run it below full employment for a period which always ends in recession.
Our economy is huge, and I'm just wondering, internationally, was there ever any influence or suggestions from the State Department in affecting economic policy, given the fact that anything that we do here could have have adverse effects or beneficial effects around the world, or the European Union or China or whatever?
I mean, I think you're always trying to get the best information you can on what's going on, and so if the Undersecretary for Economics at State had good information on how China's economy was doing, and whether if there was a recession building or risk somewhere else in the world, that was always something that was always incorporated as as information about thinking about the future. It kind of went in as a data input, just like the labor market or other things. I don't know that during my time it seemed pretty U.S. centric, because we were in recession and had 9/11, and that was sort of the dominant event. Seemed to be just in the tenure that I was there, seemed to be happening domestically.
I can add a little bit. To some extent, it depended on the people, was my experience. So, Al Larson was one of the undersecretaries in the position Mark mentioned, and he's just excellent. He was in the same position under President Clinton as a longtime career foreign, I forget what they call it, foreign affairs officer, foreign service officer. That's it, FSO, foreign service officer. And so he is just, superb, and people listened. So that's one example. I did a lot of work on trade policy, and so there, of course, the State Department was incredibly influential, and rightly so, with Secretary Powell. And so, for example, early in the administration, there was a trade dispute between the U.S. and Canada over softwood lumber, which has been an ongoing trade dispute. And the State Department was very involved in finding a solution, along with the Department of Commerce. The Undersecretary in charge of this at Commerce also was excellent in finding a resolution that worked well for our industry and worked well for them and satisfied environmental concerns. So that was an instance in which the U.S.-Canada relationship really, those kind of factors meant something for our policy.
I thought so as well in our meetings on immigration policy, that the State Department staff were just really often came with a completely different perspective from the rest of the White House staff, and just were really important in terms of bringing a different view. Again, whether they were listened to or not depended on who it was, but I thought they were really important just because they're coming with a different perspective.
What about the dynamic with the Treasury Department? Because certainly I would imagine it could vary based on who the Secretary of the Treasury is, their relationship to the President, and of course they have a significant impact on the economy also. So when you came to formalizing economic policy, how did that dynamic work between the White House, Council of Economic Advisors, and the Department of Treasury Department?
That's a great question, because I think Phil and I had very different experiences. And when I was there, economic policy was anchored pretty firmly in the White House. And when Phil was there, it was anchored much more in the Treasury Department. And again, a part of that is dependent on personalities. And Mr. Paulson was a very strong personality. I think when I came in, at the beginning of any presidency, there's going to be a concentration in the White House, just because you have a group that's been up and running for 2 years, that's been doing policy, and that there's going to be some continuation of that, and that over time the other departments and agencies will grow. One of the rules about power that is, I think, applies to almost everything in life is being physically close is really important. And so it is an advantage to be sitting in the West Wing with the President versus, even if you're Treasury Secretary, sitting in another building, because, as you know, it's easier for you to just knock on the door of someone next to you than to summon someone with all the formal proceedings that happens. And so that is important. I think you can, if you could see the president's schedule, you can almost always see power based on who has Oval Office time and who's in it. The NEC's advantage is, and this is a little bit inside baseball, but it's really important, but the NEC is one of 4 super committees, along with the NSC, Homeland Security, and Domestic Policy Council. And so legally what that means is the chairman of the NEC is the President of the United States, where the chairman of the CEA is the chairman of the CEA. And so that makes it the decision-making forum for policy decisions. And the super committees all get a regular amount of Oval Office time. And so for the NEC, we would have normally 3 economic briefings a week. And that time was where your power came from. And we were, attempting to run a process that was as fair and inclusive as possible. Important cabinet secretaries will often get their own separate time, and so the Treasury Secretary might have his own separate time. But seeing, who is in the meetings is really, is really important. It's no secret that when I was there, there was it wasn't the closest relationship between the head of the NEC, my boss Larry Lindsay, and the Treasury Secretary Paul O'Neill. Secretary O'Neill was coming from being a CEO of a company. Sometimes there's an adjustment period for all CEOs going into a cabinet position and realizing that they're no longer the top person. And sometimes equally there's a transition period for academics who are used to throwing spears at each other in debates in a way that seems normal to them, that doesn't seem normal to people who aren't academics.
That's just wrong. You're just wrong.
And, so, with apologies to academics, yeah. And so sometimes you take those two traits together, and it cannot work. I mean, so for myself, I was the deputy of the NEC, and Treasury policy ran very closely, mainly at the deputy level. So like Peter Fisher, who was Undersecretary of Domestic and exceptional, and Tim Adams, who's an Undersecretary for International, coordinated everything, worked very closely, and even when there's some friction at the top, sometimes you can make it work with close ties. It's also the case that I'm sorry, going too long, but the NEC has a very difficult personality role where you're supposed to simultaneously run an unbiased process, but then you also are, by where you sit, a independent advisor to the president. And so I had to be able to separate when I was in the Oval Office to say, Mr. President, the Treasury Secretary is opposed to this policy, and fairly say why he was opposed to it. Or the Labor Secretary is for it and the Commerce Secretary is against it. But also be able to shift hats, and if he asked me for my own personal advice, to give him my own personal advice. Most people prefer to just give the personal advice, or won't give a fair representation always of people who aren't in the meeting. And so you'll see the NEC's power shift sometimes when you have someone like Larry, who was there, who was his 3rd time in the White House, Harvard professor, Fed governor, all this stuff. We had a lot of capabilities in-house to do things and form our own opinions. And other times you'll have heads of NEC that are more process running and then are better at running a fair process, and that's what the emphasis is on, and then power will be more rested in the agencies like the treasuries. And again, it goes back to who happens to be in the job and what they're good at.
Did the Vice President have a major role in economic policy?
So the Vice President is, first of all, the sort of the public, idea that he was running everything and the president wasn't, is just completely at odds with everything that happened behind the scenes. And anyone who knows President Bush personally, he kind of runs everything that he gets his hands on. And so, Vice President Cheney would sit in on almost, every important meeting, and he was the type that would ask one really good substantive question. He would be deferential to the people running the meeting process. But vice presidents do have a separate channel. I mean, they get to have lunch with the president on their own, and so sometimes their influence can come when other people aren't around. So,
are there any other questions from the audience? Okay, we have time for 2 more questions, so let's go.
I guess I have a couple of questions if I can get away with it. One concern I have, Mark, is that I feel like sometimes the Bush personnel undersell the good that they did. You make the point that the tax cuts cost $1.3 trillion over 10 years, and I think I can accept that, but federal revenues rose on an annual basis tremendously, well over $3 trillion a year. And that seems like arguably the tax cuts increased revenue to the federal government. It seems like, would you be willing to defend that this afternoon? And then the other question I'd like to ask is it not fair to say that the Bush administration did urge the Congress repeatedly to adopt regulations on the GSEs in terms of the mortgage crisis? Is that a fair thing for the public to understand?
Yeah, I mean, so, on the tax cuts, so the $1.3 trillion that I used was the official budget score before they were passed. And so if you believe, like I do, that part of the 3.8% real growth rate after they were passed was due to the marginal rate reduction, then your cost estimate will be a lot lower. And so, Larry Lindsay did a book on the Reagan tax cuts, and it had a 41% recovery rate. And so, the estimates for dynamic scoring will be somewhere between 10 and 40%. More academics clustered at 10, but I think, to me, I look at the numbers, and and growth was higher. And so I use that as a just if that's the with no growth assumption change anything what you would get. GSEs, I mean, when I was there in 2001, we were holding meetings on them. We wanted to raise their capital standards, and you could just see that the capital level was way too low. Phil's the expert; he would know more what it was. I don't remember anything coming of it at that time, but it was something even before we got into the housing boom that we were just concerned that they were allowed to have this much lower level of capitalization than any bank would ever have.
Right. The administration took a run at GSE regulation twice. After 01, once, and it must have been 2004, and it didn't go anywhere. But the idea was, as Mark said, to increase both the capital standards and to give the regulator more power. It was an instance in which the companies had much more power than the regulator. And then again in 2006 and 2007, it was one of the things that Secretary Paulson focused on early in his tenure, and he actually had really good relationships with then Senate Leader Reid, House Financial Services Chairman Barney Frank, and others, and really pushed hard. Bob Steele, who's the former deputy mayor of New York, after his time at Treasury, they worked a lot on this. It didn't happen until June of 08, right? So the law didn't get done until the crisis came, which is an unfortunate part of policymaking. But I think they tried really hard in the right direction.
I'd like to thank all of you for coming today. I'd like to thank Dr. Pia Orrenius, Mr. Marc Sumerlin, and Professor Phillip Swagel, and of course Provost Berliner, who's always a good friend of mine for years. And just one other point I'd like to make. I thought that they gave us tremendous insight into how economic policy was developed in the Bush administration. And the next conference in a few years will be on the Obama administration. It'll be interesting to see how economic policy was formed there, and it varies from administration to administration. But the other point, and I don't mean to embarrass our panelists here, but remember their names. I guarantee you they will be big parts in future administrations, and because that's how it works. And they had very central roles in the White House, at the Federal Reserve, and so on. And I think you'll hear their names again and again, and I think they're tremendous assets to the country. And I really feel good that people of this caliber are at the point of decision making and policy making, and it makes me feel good and sleep well at night. So thank you all for coming. Thank you.
Yeah, that's something.